Okay, well, welcome back, and hopefully you enjoyed that video. Actually, if we can go back, one slide. That video is actually a great example of what we do and how we connect with CIOs and our investors. And it's a good segue into the next section that we're going to be talking about, which is capital formation. So for the next half hour, you'll hear from me and the department heads of each of our capital formation segments, really taking you through where we've been, where we're going, and where we see the big opportunities. But I thought I would start with this slide that you've now seen a couple of times today, right? You know, you hear us say often that an asset manager should not be constrained by how much capital they raise, but actually by their capacity to originate, how many good assets they can invest in. But the corollary to that is that you can't ignore capital formation. In a growing asset manager, it's been critical to continue to invest in this part of our business to be able to keep up with the scale and the aspirations of where we are taking our business. And equally as important, as Mark alluded to earlier, it's not just raising capital, it's raising that capital in the right form at the right cost of capital. And this is something I think Apollo has done and understood better than just about anyone. Okay, there we go. So I wanted to just flag a couple of metrics from our last Investor Day. When we spoke last at Investor Day, we had a couple of key targets. Wealth, we had a $50 billion cumulative target over 5 years. And happy to say we are well exceeding that. We will hit that target early. On the capital solution side, it was a $500 million revenue target by year 5. We hit that in year 2, and we'll be showing you some new targets as well. And institutionally, while we didn't put a specific number, we are well ahead of what the forecast that we embedded in those projections would show. Here are some of the numbers. I mean, you can see the growth is just astounding, right? On the wealth side, less than 5 years ago, we came from a standing start to where we are today, $11 billion raised in the LTM period. I'll show you shortly where that's headed. On the institutional side, as another example, 5 years ago, we were already one of the largest institutional players in the alt space, and we've tripled our annual capital formation since then. The important thing to understand is that our clients have fundamentally evolved and stratified and gotten more complex over the years. Right? It wasn't too long ago where we were serving broadly defined institutional clients who basically wanted the same thing out of their alternatives investments. Today, that's much more stratified on the institutional side, whether it's consultants, third-party insurance, sovereign funds, pension funds. Each of them are different. They need different things out of their investments and different things out of their partners. Same thing on the wealth side. We talk about a global wealth opportunity, but that's really multiple markets. That's family office, that's ultra high net worth, that's high net worth, that's mass market. All of these things are different and need to be served in different ways with different products. And we talk about the future. You know, I'll start by saying the future is now. We are touching all the things you see here, whether it's 401k, mass affluent, direct to consumer through long-only partnerships. This is only evolving and getting more complex. And as we think about that complexity, the way you serve these clients is also more complicated, right? Funds have always been a core part of what we do and will always be a core part of what we do. But you have to now be able to provide co-investments, co-underwrites, direct investments, strategic partnerships. You know, many of our partners and clients, they want deeper relationships, knowledge sharing, secondment. They want to co-create products with us. And only the largest folks like ourselves will be able to handle that complexity. You can see here, it seems like every month we're developing a new type of partnership, a new relationship with a new client in a completely new way. And why do we do all this? right? It's about diversity of our capital base. Apollo has the most diverse capital base in the industry. In addition to what we've built out in wealth and institutional, obviously retirement creates such a stable and growing base of capital inflows on different cycles, on different drivers than everything else you're typically used to. And nobody has the diversity that we have. Right, this doesn't come for free. We've had to make massive investments to be able to achieve what I just showed you. Right, since we talked last, we've added over 230 people in the capital formation area. We've built out a service center in Mumbai. We've built a digital marketing effort to be able to sell our products to our clients. This is a massive undertaking, again, only going to be available to the largest firms. So just marching through each of these areas quickly. Wealth, like I said, has been nothing short of amazing. You can see from a standing start 3 years ago, $11 billion in the LTM period. We're forecasting $30 billion average over the next 5 years. Now that's a growing number, so year 5 will be larger than the average. Today, this represents 25% of third-party capital, but by year 5, we expect that to be 50% of third-party capital. Today, we are a top 3 player in the global wealth market, and our aspirations are even bigger. We want to be a top 3 player in every product that we offer, if not a top 2 or top player. On the retirement services side, you'll hear from Jim and Grant shortly, but again, it's well understood we are a market leader in every channel we operate, and we continue to push into new areas. Our Asia business is strong and growing. Defined contribution is the next frontier, but you'll hear more of that from Grant shortly. Let's not forget our traditional alts business to institutional clients. Right? This is a big and growing market, and alts continue to penetrate into overall asset allocations. We intend to get our fair share of that and then some as we continue to scale a number of the products that John, Matt, and David talked about earlier. And lastly, of course, the replacement opportunity, the convergence of first fixed income and then equity, a $50 trillion opportunity. This is massive, and no one is better suited to start penetrating this than Apollo, and we are just scratching the surface of this. So this will provide additional growth over the next decade plus. ACS, a fourth multiplier, right? You think of ACS as a revenue line item, and of course, it is a revenue line item. It's a really important revenue line item to us. But for me, as a manager, as a leader, as a client relationship person, this is a key cog in the flywheel of being able to bring on new clients, start them off as transactional partners, and then grow into whether SMAs or fund investors, et cetera. So an incredibly important part of the client relationship process. So closing out on the numbers, you can see here, $69 billion on average over the last 5 years of capital formation, $125 billion today, average over the next 5 years, $150 billion, scaling over time, so year 5 again will be higher than that number. And these are the takeaways. $1 billion of ACS revenue by year 5, $150 billion of cumulative capital raise in our global wealth business, and $150 billion per year on average from our total capital formation.